Hello, welcome back to Financial Management. So this week we're going to focus on capital structure. We'll introduce capital structure in a frictionless market, and then we'll see what happens when we add one friction. So last lesson, we looked at dividend policy. We added real world market frictions into dividend policy. And so far, you've learned how to estimate the cost of capital, how to apply and use financial options, how to value managerial flexibility with real options, and you've examined payout policy. This week, we're going to focus on capital structure. The question we'll ask ourselves is, does the mix of debt and equity affect firm value? We'll see that in a frictionless market, i.e., if there are no taxes, bankruptcy, agency, information asymmetry, transaction costs, perfectly competitive capital markets, everything, the answer will be no. When we add one friction, taxes, the answer will be yes. So we'll look to see how to value firms in the presence of this tax advantage. So this lecture will be broken up into two parts. The first will cover what happens under this perfectly competitive, no friction market. And then the second, we're going to look at what happens to the value of capital structure when we have the presence of taxes. So let's revisit our friend, the present value equation. So in the numerator, we have the free cash flows for the firm, and in the denominator, we have the discount rate for the firm. If we think about capital structure affecting firm value, it's going to operate through one of these two channels, either through the free cash flow or through the discount rate. And we'll see that in the second lesson when we apply these different ways of valuing the tax advantage of debt. So let's jump in. What is capital structure? Capital structure is how we mix the debt and equity to finance the firm. So when the firm finances its assets, projects, divisions, and so forth, it's going to be using capital. That capital is going to be debt or equity. An all equity firm is going to have a capital structure of 100% equity. A firm that's 20 million in equity and 20 million in debt has a capital structure that's 50-50. If the firm is 100 million in equity and 900 million in debt, this is a highly levered firm. We would say that it has a capital structure of 10% equity and 90% debt. And that's a very common capital structure, especially when we look at banks. But in general, firms won't use that much leverage. So what is capital structure? Well, we'll keep it simple for now. We're going to focus on plain debt and equity, and we're going to assume the firm is going to be financed by a mix of the two. In the real world, firms can use very exotic securities, which are going to have both equity and debt-like features. So preferred stock is stock, but it has this debt-like feature in that if you miss a payment, then essentially you've gone into bankruptcy, you've defaulted on it. We also have junior and senior debt. We can oftentimes think of junior debt, very junior debt, as behaving equity light. And then we have different types of debt, secured, floating, convertible. There are many different types of securities. But let's keep it simple. Why would debt versus equity matter? Well, debt and equity have important differences. Debt we'll think of as having low to no risk, and equity is having higher risk. Why? Well, debt is going to oftentimes be secured by the assets of the firm, and equity is a residual claim on the firm. Debt is going to have a tax advantage through interest. Dividend payments, as we learned, have no tax advantage relative to what we think of as the tax advantage on interest payments. Debt also has priority. So debt is going to be paid off first, and equity, the residual claim on the firm, is going to be paid off last. That's part of the reason why we think of the debt as being less risky. Debt also has a fixed maturity, meaning at a certain point in time, the debt will mature. Equity has no maturity. And lastly, when we think about control, debt doesn't have control rights. Now, debt will often have covenants that will restrict certain management behavior that could destroy firm value, but it doesn't actually have voting rights. You don't get a vote when you have debt. So why would debt versus equity matter? Is there an optimal capital structure, a debt/equity mix that's going to maximize firm value? The firm is like a pie divided up between bondholders and stockholders. Now, is there an optimal way that we can cut up this pie? If you think about it, the way in which we slice the pie won't make the pie smaller or larger. It actually won't increase or decrease firm value. So in other words, using more debt or equity can only affect firm value if there's some market friction. So let's think about this capital structure irrelevance. In 1958, Modigliani and Miller showed that under a set of assumptions, the choice of capital structure does not affect firm value. Their first proposition is that in perfect capital markets, the value of the firm is equal to the present value of asset cash flows and not affected by the choice of capital structure. Stated differently, how we fund a project does not affect the quality of that project. So if I have the value of assets from a levered firm, a firm that's using debt, they're going to equal the value of assets of an unlevered firm. So what are the assumptions that we're making? We're assuming that the investment policy is going to be held fixed. There's no taxes, no bankruptcy costs, no agency costs, and etc. So we're assuming that there is no friction whatsoever. These assumptions are very similar to the assumptions we made when we studied how dividend policy would be irrelevant under a capital market with no frictions. The second proposition from M&M is that the expected return on a firm's equity is going to increase with the firm's debt to equity ratio, and it's represented by the following equation. So on the left-hand side, we've got the expected return for equity equal the expected return on assets of an unlevered firm plus the debt to equity ratio multiplied by the difference in the expected return on assets of an unlevered firm minus the expected return on debt. There are really important implications of this equation. The first is that leverage does not affect the riskiness of asset cash flows, meaning the expected return on assets for a firm that uses debt is going to be the same expected return on assets for a firm that only uses equity. So the levered firm and the unlevered firm are going to have the same expected return on assets. Leverage does increase the expected return on equity. Why? Well, it makes it riskier, but it doesn't affect the expected return on assets. That is, we have the same expected return on assets because of the riskiness of the physical assets that are used does not get affected by how we finance those assets. And that should feel intuitive. It doesn't matter how you pay for the project when we think about the project's ability to deliver cash flows in the future. Example one, you're an entrepreneur with the following investment opportunity. For an initial investment of 100 million, the project will produce a perpetual cash flow of either 10 million or 20 million starting next year with equal probability. The beta of the project, and hence the firm's assets, is 1.5. The risk-free rate is 3.5%, and the market risk premium is 6%. Suppose this project is financed using only equity. What is the value of equity and expected return on equity? As we set this problem up, what do we have? First, we have expected perpetual cash flows. So we can take the average of 10 and 20 million. That's very straightforward. Second, we want to take this average and treat it as a perpetuity because these are perpetual expected cash flows. We're given the firm's beta, we know the risk-free rate, and we know the market risk premium, so we can very easily find the discount rate by applying the CAPM. When we do that, we'll solve for the value of equity, and we can calculate the expected return on equity. Why? Well, because we can, again, plug in the CAPM. Suppose that instead we decide to partially finance this project with 60 million in debt and use 40 million in equity to finance it. Assume the debt is riskless, meaning that the debt is going to have an expected return of the risk-free rate, and assume it's being held in perpetuity. So the debt won't come due next year, it'll never come due, it's just going to be held forever. What is the expected return on debt? And what is the debt payment in 1 year? Well, if our debt is risk-free, the expected return should be the expected return of the risk-free rate. What is going to be our debt payment in 1 year? Very straightforward. We take our 60 million and we multiply that by the risk-free rate and we get our debt payment. What is the expected equity cash flow next year? Remember that our equity cash flow is going to be the expected cash flow to assets. So again, we solved for that previously, minus the cash flow to debt, which is what we just solved for, the debt payment, and everything left over is going to go to equity holders. And then lastly, what is the value of equity and expected return on equity? So when we think about the value of equity, we have to take the value of the firm, which is going to be based on the asset value, less this value of debt, and that's what's left over as the value of equity. The expected return on equity, again, is going to be very straightforward. We're going to take the expected cash flow that we get, so our expected cash flow next year, and divide that by the value of equity that we have. So what do you observe when you solve this? When you solve this, hopefully you observe that the expected return on equity is much higher than it was in the previous example. And that should make sense because we're levered up. The M&M proposition imply that an investor would be indifferent from the following choices. I would be indifferent between holding 10% of the firm that we solve for in example A, or holding 10% of the debt and equity for the firm that we solve for in example B. Why is that? Well, if we have no market frictions whatsoever, the unlevered firm and levered firm with the exact same assets have the same asset value. So if I own the debt and I own the equity in equal proportion to what I would if I only own the equity of the unlevered firm, the all equity firm, I'm getting the same cash flows. Let's put this into practice. Example 2. Suppose you own 10% of an all equity firm from example 1. What is your expected cash flow in year 1? Well, very obviously, if I own 10% of the firm, my expected cash flow is going to be 10% of that perpetual cash flow. Suppose that you own 10% of the debt and 10% of the equity in the levered firm from example 1. What is your total expected cash flow in year 1? So here we can look at what we just solved for. We just solved for the expected cash flow to debt, and we also know the expected cash flow to equity. We're going to take 10% of both of those. And what do we observe? What we observe is that these two numbers are going to be the same. The answer to A and B are going to both equal. Why is that? Well, if we think about the levered firm and the unlevered firm, they both have identical assets. So the value of the firm that was all equity is the same as the value of the firm that used equity and debt. What's different is the expected return on equity is increasing in leverage. So we saw that. We also saw that when we have the same proportion of the equity and debt as the equity of the purely equity, the unlevered firm, we basically get the same cash flow. So it doesn't matter how we slice up that pie. If I'm having equal proportions, then I'm going to get the same cash flow. Okay. Capital structure irrelevance. The choice of capital structure is irrelevant to the value of the firm. Recall when we made the homemade dividend discussion, we figured out a way that an investor could always replicate the dividend if they had a desired dividend policy for the firm. If we own shares of a firm that does not have our desired capital structure, we can do the same. We can create a homemade capital structure as well. And again, we're going to be assuming that we have access to the same borrowing and lending rates as the firm, and there are no market frictions whatsoever. Suppose you would like to own 10% of the shares of the all equity firm in example 1. So we're going back to example 1. We've got the all equity firm. We want to own 10%. However, we prefer if the firm is financed 50-50, half by debt and half by equity. How can we create a homemade capital structure so that we can effectively own 10% of the equity of the hypothetically levered firm? Stated differently, is there a way that we can make a homemade capital structure so that we can effectively own 10% of a firm that was levered the way we wanted it to be? So in this example, we want the firm to be levered at 50% equity, 50% debt. So what are we going to do? Well, we can use, two things to do to set this up. First, we want to value the all equity firm. That's step 1. And then step 2 is we want to take 10% of that equity value because that's the value of total funds we're going to have to use to buy in this share of the firm. So as we do that, as we solve down, what are we going to find? We're going to find that that 10% value can be financed in the following way. We can take our own cash and we can borrow at that risk-free rate. So if we fund our investment with 6 million of our own cash and 6 million financed at that risk-free rate, we can use those together to then buy our 10% share, our $12 million worth share of this all equity firm. What is the total expected cash flow next year from this position? So when we do this, remember, we're going to have to pay off the debt, and then everything left back, the expected cash flow, our 10% of the expected cash flow from the assets, it's first going to go to the debt payment. What's left back goes to us. And what is the expected return from this position? When we're calculating the expected return from this position, remember that we have our residual cash flow, so what gets paid back to us, and it's going to be relative to what we've put in. And that's not going to be 12 million, but it's going to be 6 million. It's going to be the value of the cash that we put up. What do you observe as you solve this problem? Hopefully, as you solve through this problem, you'll notice something striking, which is that when we do this, we've effectively replicated the expected return that we would have gotten had the firm been highly levered, had the firm been 50% debt and 50% equity. In the absence of market frictions, capital structure is irrelevant to the value of the firm. So when can capital structure matter? It can matter once we have frictions, and that's going to be the real world. So once frictions come into play, the choice of capital structure will affect firm value. Frictions like taxes, bankruptcy costs, agency, information asymmetry, incomplete contracting, the list goes on. So the next several slides are going to look at capital structure fallacies. These are common but flawed arguments for why a certain capital structure was chosen. The first fallacy is we should finance our firm more with debt because debt is cheaper. This is a flawed argument. Yes, debt has a lower expected return than equity. However, if the firm uses more debt, the riskiness of equity cash flows also increases. And we saw this with example 1. So the firm value would remain unaffected. Why? Because the increase in expected equity cash flows due to using cheaper debt payments is going to be offset by the increase in risk to those equity cash flows. So the risk is going to offset this increase in expected equity cash flow. Another capital structure fallacy that we often hear is about this sort of leverage idea. So let's read. Arguments in favor of more debt and capital structure are often made by big banks, which typically have leverage ratios greater than 95%. So this is a really good read if you have the chance. The Bankers New Close. The New York Times did quite a fun profile on Anat Adamati, one of the authors, and she's the real deal. Okay, capital structure fallacies. We should finance our firm with more debt because it will increase our earnings per share. This is also a common but flawed argument. Yes, average earnings per share are going to be higher, but the risk to earnings will also be higher because of the debt. So again, there's no way for us to mitigate the fact that the risk is going to increase when we have more leverage. So firm value would remain unaffected. Capital structure irrelevance. Picture the firm's balance sheet as assets equals debt plus shareholders' equity. So on the left-hand side, we have assets, and on the right-hand side, we've got debt and shareholders' equity. Capital structure irrelevance implies that the value in a firm comes from the assets, the left-hand side, not the financing, the mix and match on the right-hand side. That is, the firm's value comes from its assets, not the sources of funding for those assets. Capital structure irrelevance also implies that capital structure changes do not create or destroy firm value. So if we slice the pie between bondholders and equity holders, the pie itself doesn't get bigger or smaller. And again, this is if we have no market frictions whatsoever. So when does capital structure become relevant? Of course, in the real world, we have market frictions. So why is this idea of capital structure irrelevance useful? Because it allows us to examine how a specific market friction can affect firm value when we change the capital structure, when we change the mix of debt and equity. We can design an optimal capital structure with market frictions in mind. For example, taxes. What we're going to show in the next part of our lecture is that when we have debt, because debt has this tax deductibility, there's going to be a tax shield that's very valuable. Agency, what we'll show later is that how we have debt is actually going to affect firm value through agency concerns. So this is going to conclude the first half of our lecture. And in our next half, we're going to jump into capital structure and tax policy. And we'll look at how taxes will make capital structure very relevant.